get filled. So we as retail traders should not care either. Now, again, we do have time restrictions as a retail trader, meaning like, well, we can only trade for a certain amount of time. We can't be holding contracts, especially if you're in prop accounts, things like that. You can't be holding contracts for, days on end. They don't let you do that. And most of us out here today are trading prop accounts, evals, PAs, whatever it is, funded accounts. I don't care what it is. The rules in those accounts don't let you hold contracts long term, like an institution. But we can still use the same thought process. We don't care how long it takes. We just have to have three things. And I say this all the time. You have to have a bias. You have to know what direction you want to trade for the market. You have to know where you want to trade from before you take a trade. And once you get in the trade, you have to know how you're going to manage said trade once you're in it. That's it. That's all trading is. And when you can get that down and break it down to that simple, you're going to do better as a trader, knowing that you don't have to be in a trade right now. Price will always at some point come back and give you the trade you want. Okay? So that's number one. So we use these tick chart candles because tick charts don't have a bias on time. It's just price action. So I like that because it gives us more of a institutional looking bias in the sense that we're not worried about time. We're just worried about if X happens, if Y happens, if Z happens, then this is our bias. Then this is what we're going to do in the market. We build a rule set. So our rule set simply says that this becomes a neutral market. Why? Because price, we're using the VWAP and the 89 exponential on the 2000 tick chart, as I said before. And so if price can't stay above or below that 89, okay, just like this, then we're going to call this a neutral market. How do you get a bias in a neutral market when again, we've already done levels, so I'll come back to those in the training video. But when you're looking at a market like this, how do you make a decision? Well, you have two answers to this question. And again, we use a very simple bias. If the 89 is pointing up and price is above VWAP, what do? We buy it. If the 89 is pointing down and price is below VWAP, what do? We sell it. That's our rules. Really that simple. Okay? But in the grand scheme of things, the markets don't let things be just that simple. There's going to be situations where you have to say, well, this could happen or this could happen, meaning that price could move below or above. This is where your levels come in. So this is why levels is always number one. When you look at a situation like this, you pick your level, okay? You have your levels and price is respecting these levels very well. Coming into the open here on this day, they still respected it. So pretty quickly you could end up with a bias that says, okay, this is a neutral market. Flip a freaking coin. Do I want longs or do I want shorts? Well, the way I would look at this is prior price action. Are we above or below prior price action? Well, in this scenario, we are neither, okay? The only thing we have to look at is a prior high, and price can't break that prior high. So in this scenario, I would say even though we're neutral, we're going to be moving into short trades, scaling in, using a dynamic sizing methodology to get into the shorts and take off contracts, okay? Again, the next video, we'll train on that. So now you could say completely neutral because price is staying below this, but the other factor I look at is we have more price action below the level than we have above the level. So there's my tiebreaker on that. I'm looking for shorts. Vice versa, if we had more spikes above all these prior swings and it was still bouncing back down in here, I would have the long bias. All right, so that's how you deal with a neutral market. You either don't trade it, or you've got to look back at prior swings and say, okay, are we staying above those or below those? We're staying below them, we're going short, okay? That simple. All right, so there's your neutral bias. Let's move to a trending bias. This will work just perfectly fine here. We'll have a short one and a long one here. Okay, on a long bias. Now, this is great. This is the reason we like this thought process is usually we've made our money coming into these shorts, and then just like what we do, we'll say, okay, once we get to a certain level and price has exceeded what we expected it to do, then we'll put a stop in, okay? Maybe a stop here. You're guaranteed money at that point. You've taken plenty of contracts off. So you put a stop in, and again, we're gonna go through the training part in the next video, but you would look at, hey, what's going on with the 89 here? Well, the 89 is starting to turn up. Now here's a really big hint. We had a move down, 89 turns up, breaks through VWAP, and then we have price stalling here and starting to stay above this level. 89 clearly pointing up now, above VWAP. Now our bias becomes a long bias, meaning that the next time price pushes up and tests our level, we'll add a contract in that long bias. And then we'll add another contract and we'll take profits. And then you do that every time it comes down and comes back up. Now again, I'm going to train on this in a couple minutes on the rules, but that becomes a long bias. I'll show you a better example of that in just a minute. Now this is a great example of a short bias. We started out on this day with a very clear short bias. And again, level to level. So in a situation like this, price staying, 89 is pointing down, huge move down. This is a good example of bias. You don't change your bias just because price stays above the 89 and VWAP, considering it's a down market, okay? You keep that short bias until price decides to stay above the 89 and VWAP. And so what do? When we go through the training video, you'll see that we'll add through these push-ups, and these are times where when you have this short bias, these are huge profit days on these trending days, because you want the bigger push up against you for that bigger profit opportunity. And again, we'll talk about that in the training video, but this is short bias. So you don't change your bias here. And I'm gonna walk through several different scenarios here. And again, we'll go through the training, but we stay in our short bias through all of this. This is a beautiful way to trade. Now, here's what's beautiful. Look at this. You come back later in the day. Are we still trading this later in the day? No. But when do you switch your bias to long here? 89 started pointing up here, right? Okay. You look at the level, okay? Are we staying above VWAP? Yes. You switch that to a long bias. Okay. You're staying above the level and VWAP. And again, same thing. This is a good one to look at here. A lot of people would say, well, wait a minute, this is price staying above. No, it's not staying above. This is a test above VWAP. This is above VWAP, a push to the next level. Now, is this a scenario where you wouldn't be trading? Absolutely. So again, as a bias on this, when price comes up and starts to stay above VWAP, you want to stop trading that. You can't go this deep into a trade. Again, we're going to talk about that in training video, but you would probably say, I'm going to cut my trade here. But again, you're still having a short bias. You just are not trading this. Okay, now it comes back down, you start back trading it short again, and you stay here on the short side. Let's go to another scenario here. Again, when you get a situation like this, I went through that earlier, situation like this where it won't stay above or below, you stop trading. Just stop trading. You stop that. Don't do that. All right, we have a really good scenario here, what we're talking about for bias. Again, bias, I'm going to go through all the different scenarios we've seen recently, and that should really give you a good idea of how to understand our bias thought process. In this thought process, yes, your bias starts down short, okay? However, you can make money in this. There's money to be made. However, from a bias, our bias also says we put a line in the sand that says, hey, if price breaks above this level, we're going to think about changing our bias, or we'll stop trading for a minute, okay? So you've got to pick your strong level. And this is why levels are so important in a situation like this here, okay? Again, you're looking back to the left. Is price staying above prior price action? Yes, it is. Okay, did it go above VWAP? Is it 89 pointing up? Yes. Okay, maybe I stopped trading for just a minute. Okay, I just stopped trading, and I want to see price retest, and then I can go back with that long bias when things have turned up here and make money on the long side. And same thing here. Price comes down. Is price staying below prior price action? Well, we're kind of in the middle, so you might want to be neutral for a few minutes until you can see a retest of this VWAP in 89. Then you can trade that on the short side. Okay, that's the bias. Now here's an easy trending market. These are the easiest markets to trade on the planet. When you have a big separation between VWAP and the 89, you have lots of room to play with this, lots of room to take trades. This is long, all day long. You don't change this bias until when? Okay, well, this is why we always do this. We always look back and say, well, this is a pretty strong level based on today's price action. So many times what we'll do in a situation like this is we'll take this line and say, hey, let's change that color in the line my level. Let's make sure I have noted that that level is an important level. And now I know if price comes back and stays below this level, then I start to change my bias or stop taking longs. But in a trending market, you don't get that often. We saw that today as well. So you trade this as hard and heavy as you can to the long side. That means when you're trading this, again, I'll teach this in the video, when you're trading this, you don't need price to come all the way back to a level to add contracts. And I'll talk about that when we're trading. All right, super long bias, easy trading. This is easy to do. When you see this start to change around, again, same thing. Is price staying above prior price action? Okay, no, it's not. The old school definition of bias, lower highs, lower lows, get it? Higher highs, higher lows. We still use that. But in the grand scheme, they have to be in relation to our 89 and VWAP. If I have price action sitting around 89 or VWAP, and I'm looking at this, I don't know what's coming next, but I'm looking at this says I should still have what? A long bias. However, what am I seeing? Low, lower high, lower low, lower high in comparison, and then we push down here a little bit, a lower low. Now all of a sudden I say, well, maybe this market's changing its mind. So you have either a neutral bias, which we don't typically want to do that after an all-time high or after a huge run up like this. Typically the market's going to get tired. So you probably want to sit on the sidelines after these big moves up or down. Let it figure itself out. If you want to keep trading, obviously you look at the lower lows and lower highs and you trade that to the south side or to the short side as a bias. So really simple. When in doubt, go with the old school definition of a bias: lower lows, lower highs, and higher lows. Usually that's not a big deal. We usually have that bias down. Now again, this worked out really well. You're looking at lower lows, lower highs. You would have traded that into the short side as a bias. Again, here you start out on the short side. However, you're very compact in price action. This is a great rule that I have. This is a huge rule. Emphasize this. When you're doing any kind of, again, what we're calling it dynamic sizing methodology, this is so the AI can pick it up and point this out. When you're doing this, the other rule in bias, and the big rule in the bias, is if you have no new highs and no new lows, and you're hovering around the 89 and VWAP, and it's hovering around a level, which is not a coincidence. Levels like to be attracted. Prices are attracted to levels. Get it? Boom, boom. Then this is a market you do not trade. Absolutely. Let me emphasize this 1,000 times. No new highs, no new lows. Stop freaking trading until the market breaks out and gives you a direction. Okay? Do not trade no new highs, no new lows. You can't do it. When you got a consolidating market, you don't trade it. That's you're guessing. You're guessing on a breakout one way or the other. You're going to get burnt big time in that market. Don't do it. Okay? So no new highs, no new lows. Don't do it. Again, you get back to long bias. This is a great one right here. When do you switch to short bias? Well, you have long, and then you come down here. Where is your catastrophe? If this is where's your level? Okay. Well, you look back at price action. Well, you kind of have to look. You have a level here. When you look back, that's pretty strong. You have a level here. When you look back, that's pretty strong. So what do you do in a situation like this? You're going to have losers, okay? Unfortunately, in a situation like this, and this does not happen very often, okay, price usually will push back up, give you an idea that it's going short, and change around. So this is a scenario where if you're using this process, you have to just pick a spot and say, I am only willing to risk X amount of money before this goes down. Now, usually you're looking at the strong level down here, and that would end up being a loss for you for the day, but that's okay. What do? Well, guess what? You clearly have switched to a short bias at this point, okay? You start trading on the short side. That loss is recouped in no time flat, trading from the short side, following the rules. There's no set of bias rules that are going to be perfect ever, but this is pretty simple bias. And you're telling me you can't recoup those losses in that bias? Absolutely. Again, really strong long bias. We covered that a second ago. You should mint money in those environments. Literally, you should just be minting money in these environments. And again, so here's a big swing environment. This is a really big swing environment. The only way to trade this is pick a side. Now, obviously, you've had huge up environments. Okay, so you probably want to be toward the long side. And again, as a bias, you still have to say, oh, my bias is long. Well, where do you change it? Again, prior price action, you put a line in the sand here, and you continue trading this on the north side until you get an indication that price is going to roll over, and it does here. You should have taken plenty of profits with your long bias at that point, and now you switch to the short bias. And same as the long bias, when you have these big trending short biases here, you should be minting money, and especially with the separation between 89 and VWAP. You usually have, and that's a big emphasis too, when the 89 and the VWAP are separated this far, they have this much divergence between the two, then you really want to trade that hard and heavy to the short side. And again, same thing on long sides. So those are our bias scenarios. That's what we go through on bias. That's pretty much all you're going to see in the markets. Again, I'm not going to use that in trading, so let me stop this. You guys can open your mics up now, and let's talk about bias.
That was good. Real good.
What? Published. All right, kiddos. Bias. Dan, David, Tom, open your mics up. Start asking questions. We are not recording anymore, so don't worry about it. Your voice won't be on the thingy-majingy.
Did that make sense for everybody?
Questions. Answer. I'm going to finish rendering this video, but...
That was good.
Did you guys take notes? Come on. Help me out, guys. Ask some questions. I thought it was pretty damn good.
Feed him. Somebody feed him.
Feed me, Seymour.
Lead him. Feed him.
Feed me,
Nobody
Seymour.
has any questions. That made sense. Anybody listening?
Dude,
That's not
say
right.
something. At least type something in, people. They fall asleep when they listen to me
Say,
now.
no, this was garbage.
Do something. I mean, smack me in the face or something like that.
It's
God.
amazing though. I've heard you say that a million times, but every time it makes it's so clear and so freaking easy to see.
That was my first time doing it too. Ever. First time ever doing a bias training video. Oh shoot. Never mind. I got one running already. Stop that. Stop publish. Never mind. Okay, well if you guys, I gotta wait for this little video to render here, but
What time frame do you pick your levels from?
hey, that's a good question. However, that's in the levels video, David, which I'll get to you. That's in the levels video, which I'm not trying to sell you something, David. I'm doing this for you, but that we're building this course, and I wanted you guys to be in. Now, obviously, that Dan and all the other guys that are legacy members get that, but that comes. That's the $99. So you get this whole thing for $99, David, when it's all done. If you want to wait for that, but I'll tell you right now, levels. So there's no time frame for levels. Okay. You'll get the whole package. It'll be cheap. It'll be cheap. But again, I'll tell you right now. So I use, I was using daily, 60,000, 30,000. Okay. So instead of using, and so I switched from that because I have a better feel for the market when I go with these huge tick charts, because now I can see these major levels where price stops on these candles, right? Does this make sense? So think of it like multiple time frame analysis, right? Okay, so this is multiple size tick chart analysis. It's the same concept. We're just using tick charts because time frame sucks, in my opinion. I'll never use time-based charts ever again. And here's the reason why. Yeah, this is volume-based chart. Well, I mean, why not use this? You don't have to wait for time or anything to tell you. This is clear as day. So I go from a 120,000 usually to a 60,000 just to see if there's multiple candles there. And this is going to give you really, really good levels. One of my favorite chart right now is the 60,000 tick for levels. Okay, if you only use the 60,000 tick levels, you're going to do good, because just wait for price to stop and stay around. Okay, a level. You're going to be pretty good if you only use a 60,000 tick, but you can get a little bit more finite. 30,000 tick does me really well. You can see these rejections. You can see where price hangs around these levels. I like that, and then I fine tune it. I fine tune it down here on the.
Which is what we trade off of.
Was it on the 2000, which is what I trade off of, because I want to see price action, and I'm gonna do this in the next training video. I'm gonna talk about why, if you get good levels off the big tick charts, why use use the 2000, because we still need to see price action. There's things that happen within smaller tick charts, like you can see this better on a smaller tick chart. Price pausing here. You know, if you're looking at a 30,000 tick chart, well, this is all one candle, and you don't know that this might be reversing, coming back down. So you make a better decision on, hey, do I put a stop in here and then wait for it to come back and load back up on contracts? Same thing we did this morning, right? Does that make sense, David? So it's multiple size tick charts, and that's where you're going to get. So if I were you and you want to start doing this with me, are you asking this because you want to start doing the MES with me, or at all? I'll give you some advice on that. Okay, if that's a no, that's fine. I won't do it. But, and this thing won't stop going up. But so, okay, he's like, "Shut up, Brian. Move on."
Shut up, Brian.
He's like, I got it. Shut your mouth, boy. All right, so we're gonna move into. We're gonna do a couple different things here. I'm gonna go first video. I'm gonna go through the rules of what I do, my thought process on the MES situation. I don't really care where I'm at. I guess I should start back on rules with neutral, or the neutral market. Okay, let's do that. What day was that? That was April 27th, right? Come on. Here we go. All right. Let's get this puppy spread out just a little bit more here so we can look at this. And all right, so I'm going to do the basic rules, and then the next video will be a little bit more advanced breakouts, stuff like that. When to add on a breakout, when not to add on a breakout. But we're going to do basic rules right now. I would suggest you guys take notes. Tom Hutch, you taking notes? I know he is. He always takes notes. Let me get the video running. Let's see if this thing's rendered yet. Try not to overload this program. Last couple of seconds from rendering. I wish you guys would ask questions. Let me go ahead and let this finish rendering. I'm going to use the word positive expectancy. I like it. Reason being is, what are we doing? I'm going to ask you guys real quick. What are we doing by using the bias we have and the levels we use? What are we really doing there? In the sense of the thought process where you don't get, so here, you know, a lot of people say that this is a martingale type of trading. It's not. It's not even really dollar cost averaging. Well, it is when we get deeper in, but it's not really dollar cost averaging, because you use more than a couple contracts typically in dollar cost averaging, right? Does that make sense? That makes sense, right, Paul?
Yeah.
I wouldn't really call it dollar cost averaging, because we're not really doing that. What we're doing is a tried and true thought process on trading the markets to make money. This thing just won't stop going up.
I was thinking of just let it pull back a little bit and putting one on. A little relief and then take it.
Wait for a pullback. Well, holler at me. I'll get it on another chart. Okay. Let's rock and roll on this one. Let me find my button down here. Too many freaking things. That's the problem with the new setup, Paul, is that way too much screen space. And not to mention, I could turn on 2 more monitors back here that I don't even use. Stupid. All right, let's rock and roll. We're going to go with basic rules. I'm trying to figure out, I need to use the Epic Pen for this because I'm not trading live. Epic Pen. Okay. Let's do some rules. Okay, in this video we're going to talk about our rules for our dynamic sizing methodology. What does that mean? It simply just means that we're using our levels, which we talked about in other videos. We're using our bias, which we talked about in the previous video, and we're creating a thought process where we add and take away contracts. And this is on the MES. Again, you could do this on the NQ, but at the same time, the thought process behind our training here, our trading here, is that we don't want to take a lot of risk to get the reward we want. Meaning that we don't want to go in, even on the micros, we don't go in 6, 7 contracts and hope that we're right. What we're going to do is we're going to come in with 1 contract and then add another, and usually never get more than 3 contracts on the MES. Now, that doesn't sound exciting to most people, but at the end of the day, when we're using this process, like today, for instance, I crunk out $304 on 2 different accounts, $292 on 2 different accounts, and $107 on 2 different accounts. So you do the math on that, and that's never getting over more than 2 micros on the MES. That's a paycheck for a day. That's what most traders wish they could get every single day. We're doing this every single day. Now, do we do that every day? No. We're averaging about $100, $110 per an account every day. Multiply that times 10, 20 accounts, that's a paycheck. And that's what we're trying to do here. We're trying to create a way for traders to have an easy process to get into trades, manage their trades, and fix that one thing that traders have the most problem with. The anxiety of, I've got to do this, I've got to do this. Well, if you're sitting in a position all the time, that usually is going to relieve that anxiety of having to pick your trade. What are we doing? We're picking our trades in advance. All we're doing in this process is we're saying, hey, we've already identified our levels ahead of time, right? We've already done that. We already identified a bias ahead of time. This one's neutral, slightly to the short bias, okay? So we've already identified that. Now all we're saying is when price, again, now one of the things that we'll do, we won't do this in a neutral environment, but we'll do it in a trending environment. Let me erase that one. We don't need that. So all we're saying is that we're saying, okay, once you have a bias, once you have your levels, then you're going to say, okay, well, if I have a short bias here, I'm going to let price get up to close to my level. Why is that? Okay, I want to add plus a short contract. Okay, slightly short contract, even though this is a neutral market. I want to add a short contract here on the MES. Okay, now somewhere in this area, it doesn't have to be perfect. You want to be close, usually within maybe 2 points of your level, one side or the other, 2 points, and a short bias. So this is the rules. If your short bias is, you're always going to add a little below, a couple points below your level. Why? Because a lot of times price stops a couple points below your level. That's just how the markets work. There's nothing perfect in the market. You have levels, and then once you say, I've got this level, then you say close is close enough for the trading purposes. Because again, we're adding 1 MES micro here. So if this just shoots up this way, okay, it's got to go all the way to past here before you even down $100. Okay, it's got to do that. That's not likely going to happen. The odds are is exactly what happened here. It bounces up, pops around, comes back down. Okay, well, great. Now, a lot of traders are going to say, I'm going to go ahead and take profit here. In our thought process, absolutely fine. Take profit here. But what I'm going to say is I'm only one short right now. So I'm going to let this come back up to close to my level, add another short, okay? Now, that brings my average fill price to somewhere right here. Fine. If the market even keeps going up here, okay, I'm fine with that. As long as it doesn't break my spot here that I'm saying, again, we're looking back at prior price action, which I said in the earlier video, is we're looking back here to say, if price can't go above this, if price does, let's do it this way, if price does go above this level, okay, I kill the shorts. I'm done. I take that loss. I eat it. Okay? You're in 2 contracts at that point. Who cares? It's not that big of a deal. Okay? But if it doesn't happen, let me get it right back on the line I was at. If it doesn't happen, then we are 2 contracts deep. Then you're taking profit here. Okay? So you're minus 1. So your net 1 here. That's taking profit. We now have established our core 1 position. And now every time we get a pullback, again, adding a contract. We're going to add a contract here. And then in a neutral market, one of the big things, this is a rule for a neutral market. You must have this down. When you're in a neutral market, you don't want to be aggressive with your targets. Now, I'm a person who is never aggressive with my targets. I take my profit, I take my targets well before the next level, unless I'm in a huge trending market. So if you're adding a contract here, or even here, okay, you're adding a contract here, you're probably taking off, especially in a neutral market, somewhere around like that, called VWAP in 89. So then now you've taken 2 contracts in profit. Okay, that's 2 contracts you've already taken in profit. Now what do? You're net 1 now. When price comes back up here, you add another contract. And it pops around, you sit and wait, sit and wait, sit and wait. Guess what? You've got another target sitting down here. Now you've added 3 contracts. Ugh, looks like a kindergartner wrote that. You've added 3 contracts on that. Now, in this situation, you've taken profit 3 times. You make a decision. Do you want this trade to stay 1 net short, or do you want to say, hey, let me put a stop in here, okay? And if it comes back on me, I can already load back on another one. That's what I would say. That's the user discretion, okay? Me, depends on the market. If I know this is a strong neutral market, which I'm seeing right here, I'm probably going to leave that net 1 short and let price come back up and add another contract. And in a situation like this, I love these situations when you have a neutral market, because it gives you a lot of opportunity to add and take away. So again, you're adding 1, it's going to come back down here to 89 VWAP. You're going to take that off. Now you're deep. Now you've taken 4 contracts, okay? And then again, you're going to add again. You're going to take off again, 5. Add again, take off again. That's 6. Ugh. What is going on here? That is 6 contracts. And at some point, this probably should get you to a little bit over $100. Now, if you're copy trading this, that's all you got to do for a day. That's it. You got 10 contracts. You're at $1,000. Stop trading. Be done. Quit. Wait. Don't do anything else. And that's my rule set too. In the rules, once I get over a certain amount, I get down to the point where I say, okay, well, the market's going to have to do something different for me to want to trade this again. I will take, like, once you get down here, this is when you put that final stop in. When this structure starts happening, you put the final stop in, you get flat on everything, and then you wait. Again, the rule set says that once you've broken over $100 on your MES trading, because we're assuming that you're going to copy trade this, protect that capital. Protect it. At all costs, you protect that capital. Okay? So that's the rule set for trading a neutral market. Now, what happens what happens if you're still trading this and the market decides to change its mind and pick a direction. Okay? Market changes its mind, decides to pick a direction. If you're still trading this, okay, from a neutral market to a, let me slide this back a little bit, from a neutral market to a long market, and you're still in this trading, so let's say maybe you got a late start on the day and you said, okay, this is still a neutral market, and you did the same thing. You're adding contracts up here, you're taking minusing contracts here, you're adding here, you're taking away here, you're adding here, you're taking away here, no more adds. So again, in our rule set, you probably put a stop in here. That if you that's the other big rule. This is what I'm trying to say. If you see price staying below your major level or the level that you're trading, or your, I call it the line in the sand. You got to draw a line in the sand. If you have a short bias, okay, and it starts to run, and you can't add contracts, put a stop in. Okay, that's one way to do it. Or you keep trading the retest of this level. Okay, so maybe you did that. Those are our two options. Then you would add here. Okay, that would bring you down to 2 contracts with a net fill price probably still sitting somewhere around there, and you don't get to take this off. Okay, so you're stuck. You're stuck in 2 contracts. So you're stuck in 2 contracts. What do you do? Okay, you're plus 2 contracts here, and you don't know this is going to happen. The markets aren't going to tell you that it's going to happen. Now, you can use some things here like see a head and shoulders pattern, right? You could try to say, okay, this looks like a head and shoulders, so that might be a reversal pattern. That's really advanced. You got to be like top notch as a trader to identify that and say this is a possible reversal. If you don't and can't identify that, again, you always have to keep your eye on this 89. Always. Never take your eye off of it. Okay? So this might tell some people, this divergence between the 89 and VWAP here, that this is going to be a strong short. At some point, when price ekes its way back up to your level and inside where you're trading, you don't keep adding contracts, okay? Once you have a failed, you have a failed continuation, right? Price should go level to level, right? And then it should have been bouncing around here. Did not happen. So when that doesn't happen, and you get back up to your level, then all of a sudden now you have to say, this is my catastrophe loss. You got too deep, you're holding it, and maybe this takes you back to break even after all the stuff you did over here. Fine. We are not smoking hopium when we're doing this. We're saying if we take the loss, we just take the loss. You got to do that, okay? Because this process is going to make you way, way more money in the long term if you follow these rules. Price comes back to your level, and it's staying at the top side of your level. You've got to get out of these 2 shorts. Now, you have 2 options. Close the trade, okay? Option 2. People hate hearing this that are gurus, but in my thought process, if I see price reversing, 89 coming up, I'm getting big divergence here, okay? I am going to reverse the trade. Why? Because now it only takes to here for me to recoup any losses I took from here, because my average fill price is sitting down here somewhere, okay? See that? 1 to 1. So you got to keep track of this is the other thing too. You got to keep track of your average fill price. All right. I can do it mentally. If you can't do that, find a program that will keep track of your average fill price for you. I'm sure there's indicators and stuff that'll do that. I can do it mentally. You can also look at your control center and say, okay, am I losing X amount after I gained X amount? Either way, it doesn't matter. You've got to know what that break-even price is when you reverse it, if you want to reverse it. What I suggest to most people when you're starting this, close that trade. Just close it. All you have to do is now switch back to the long bias. Let this come up here, retest, and guess what? Now I'm +1 long. Oh, great. Strong long bias now. on the strong, here, let me, we're going to switch to the strong long bias here. So now we switch to a strong long bias. This, I love the strong long biases, strong short biases. I'm going to use a different one for this. I'm going to use this. This is a good one for the strong short bias, and I'll do a strong long bias later. So either way, it's the same concept. So on a strong short bias, again, extremely important. Let me back up here and just cover this one more time, because this is going to happen to you. This is going to happen to you. Market's going to reverse, just like I talked about in the bias video, and we'll cover that one in a minute. The markets are going to reverse. You can't hold these trades thinking that it's going to go back in your direction. You've got to follow the rules. The rules say 89 pointed up, divergence above the 89, above the VWAP, well above VWAP. Okay, we didn't get that anywhere here. Nothing. That did not happen. Okay, that's starting to happen here. Not to mention the fact that price, what is this? Higher highs, higher lows, higher highs, higher lows. Get out of the short, reverse it, close it, whatever you need to do. Just get out of it. Start trading it from the long side. Okay. Just want to recover that, because that's something that people will mess up on. Don't hold this. We're not married to these trades. Don't get married to anything in trading. Ever. Ever. Okay. So now, again, here on the short side, and we'll cover the long in a second. Obviously, strong short side. We don't have as big of a separation between, this looks like it's not that big of a separation between VWAP and 89. However, and charts can be deceiving. However, this compared to prior price action, right? This is a huge move. Now, obviously, most people wouldn't catch that because of the time of the day. However, from a rule standpoint, this is a huge move. If I were to spread this out, now all of a sudden that divergence becomes greater. Okay, it's much bigger. So the point I'm trying to make is big trend. This is a pretty big short trend here, and these are easy trading environments for our thought process, because now I can go whole hog on these. These will be ones where whole hog. These will be ones where maybe we start trading around 9, whatever. These are gonna be ones where I'm gonna say I got my levels. Now, guess what? This is a rule that I'm gonna add here in a couple minutes. As price continues in this situation right here, I would still use my major level as my line in the sand right now. Price can't go above that right there. If it does, I stop trading from the short side. Okay. Now, I don't mean like peak above it, peekaboo, and then bounce around and come back down. I mean, it means it go up, come down, test it, and go up again. Cut this, get out of this, exit out, do whatever you need to do to get out of that. Okay. So that's a big rule there. That's the reversal rule. We'll call it the reversal rule because it makes sense. The reversal rule says if it breaks your line in the sand, the level that you have, and stays there, either reverse or close out, lick your wounds, and come back and trade from that direction that it picked. Okay. Now, so we have our levels here. Let's say we start, maybe 930, whatever. We traded this. We actually crushed this one. So again, couple points within your level. You add a contract, 1 MES short. Great, awesome. You did a good job, Brian. Yay. You get nothing here. Now, again, you can always put a stop in. Okay, sometimes I do, sometimes I don't, depending on the market conditions at that point. But in a situation like this, I probably wouldn't. Strong downtrend. I'm going to add again back here at my level. Oh no, it went against me. Well, it's not way against me. In a strong market, I'm probably going to go and get me a third contract. That way, my average fill price, I got 2 here. My average fill price is going to come somewhere around maybe right here, just below the VWAP. And guess what? I'm going to take profit when price does what? Breaks back below my level again. Because now, once I take profit there, I'm -1 right here. I'm going to be net 2 contracts and still going to have a target here for a -1. Okay. Now I'm back down to 1 net contract short. And then again, easy stuff here. Now this is one of the things. This is a situation where if you're really strong on the short side or long side, you can take these little baby levels, and this is what I was talking about earlier. You always will have what I call baby levels, not as strong levels, between levels. You can see them here, right? You can see these levels right here between the levels. Those aren't the major levels, but in a strong trend, you can add one on that, and then you can add one here. Now that's user discretion, but if I'm in a strong trend, I have no problem getting up to 3 contracts on this, because what I'm going to do, I'm going to take profit here and here. I'm going to minus those up. That should be minus signs. I'm going to minus 1. Sorry, minus 1 here, minus 1 here, back down to net 1 contract. Guess what? This pops back up. I'm adding 1. I'm minusing 1. Pops back up. I probably wouldn't hit those at all. Maybe add 1 here, but that's again user discretion, depending on how aggressive you want to be. But you add 1, take 1 off. At that point, you're very deep into profits, much like what I did today. So now you can get a little bit more aggressive with this. And again, you come back down, test this level, come back up, a little midpoint here, just like I was talking about. This is another add right here. This is a minus, add, minus. Really simple here. In trending markets, it's hard to screw up. Add, minus. You get it, guys? Add, minus, add. Guess what? You couldn't take target here. Oh no, but you're only 2 contracts deep here. In a trending market, we say that you can get 2 or 4 contracts deep. So what do? Let it get to the next level, okay? Add, and now you're 3 deep with your average fill price still sitting somewhere down here. Minus 2 contracts deep. Now I'm holding 2 contracts. Oh no. You make a decision. Do you want to be back 3 deep and have 2 core at this point? You could do that. That's a little more aggressive than I'm probably going to be, but you can totally do that. I'm trying to erase this. So you can totally do that in a trending market environment. Now I had a concept I was going to think about here. So that's how we do it. So you get aggressive in trending markets, and then make sure that you're adding and taking away. Now, another thing I want to talk about in a trending market is when do you stop? Okay. The other thing I really need to talk about is when do you stop? Okay. When do you stop? Because you get huge separation between the VWAP and 89. And the other thing is you no longer get tied to your line in the sand. If we're trending down, your line in the sand needs to come down with it. Okay. So you can't let price come from here all the way back to here. Like, that would be insane, absolutely insane to do. Okay, so as the market's moving down, you're keeping track. Now, this may be a lot for some of you to keep track of, but you've got to keep track of 89. We're in relation to VWAP. Also, you got to say, well, my line in sand was way up there earlier, but we're way down here in price action. You've got to move it down with your trading. Okay, so my new line in sand, as price gets down to, when price goes from level to level, get it? It's going to go from level to level. So when it moves down to the next level, so does your line in sand. So for instance, when this got down to the next level, my line in sand's got to move down to here. Price gets down to the next level, my line in sand's got to move down here. I can't let price go back too far against me. That's a silly thought process. People think martingale trading, no matter what, price is always going to come back, and they'll just add, and then all of a sudden you're down, $5,000, $10,000, and you're like, whoa, shoot, I blew my account. No, that's dumb. Your line in sand's got to come down as we go down in levels. Very simple concept, but you got to see that. In a trending market, this is where a lot of people will screw up. They will not have I've got it, what do we call it? Like pull the safety valve or something. You've got to have that, get out of here, stop doing this thing. So when do you stop? When do you stop? Okay? So you're making money. Well, we're down at this level. This is my line in sand. Do I really want to get to this level and say, I'm not going to do it? No. This is why we look at this little guy right here called the 89 and say, it'll go flat sometimes, it'll point up sometimes, but this is a strong, strong move up here. So you've got to have a thought process that's going to say, hey, okay, when do I stop this? I've made plenty of money here. First, you should not be greedy ever, ever. Never be greedy when you're doing this. You can't be greedy. All right? At the end of the day, again, what's the first rule of protecting your capital? You get over $100 in this, and what we're trying to do, again, keep in mind, we're trying to build a process where you can use multiple accounts, copied over many accounts, and then once you get to that level, again, my rule of thumb is over $100 per an account. I start protecting my capital. Really start protecting my capital. If it's really trending, I'll keep trading it like today was. I'll keep trading it up to $400. But if it's not over $100, I'm going to start really tightening the belt and saying, okay, if price sees a bottom and we start getting a new high off of this, I stop it. And the other telltale sign is when you start seeing these structures here. So this is a big thing for me. Price action, price action, price action. Price action couldn't go below here. New high, new low, new higher high, higher low, higher high, higher low. At some point, you stop. Now, this would be your line in the sand. If this is the only rule you use, as in your catastrophe, what I call a catastrophe stop, or oh no, I got to get out of this, you would give back some money here. That's fine, because you would probably be what? 2 contracts deep. Now, actually, you probably would have taken targets. So you'd probably, 2 contracts deep because you would have added one back here. And then, somebody else might have added one here. So you'd be 3 contracts deep if you really, really didn't recognize the reversal. But you have to stop it here. You have to cut it off. This is your line in the sand. Price comes up, test it, bounces back off. You got to get out of that. Now, you gave back some money in that scenario. Again, if you're trading this with me, I'm going to tell you to quit. Get out of this. But if you're doing this on your own, you're going to get back some money in these scenarios. That's fine. Overall, you just killed it through this scenario, so that's fine. Give back a little bit of money. Who cares? All right, let's do a long.
We already missed it. I didn't want to interrupt you, though.
What? I know. No, this is recorded. I can't do that. Here's a good long. All right, long scenario, same thing. All right. I would always have a initial, hold on a second. Let me put this chart back where I want it. I'm going to squeeze this in a little bit. You guys only see candle to candle right now. Let's go back here. This is a great scenario of price changing directions. So this is a really, really good scenario where you start off with, guess what? Probably a short bias. Okay, that's fine. So you start with a short bias, and again, level, adding contract. Now, is this a strong short bias right now? I'll ask that question. It's not. I wouldn't have a strong short bias because where's price staying above prior price action. Got to keep that rule in mind. Huge rule. Huge rule. You have a slight short bias here because price is staying above prior price action. Okay, that's a big deal in our rule set. Big deal. Okay, where's price staying above prior price action? I'll show you that on the long reversing to the short as well. So you're not as aggressive on the short as we were talking about earlier, but you can still trade it on the short side. Why? I gotta add at a level. I gotta take away at a level. Or add that level. Take away at a level. Maybe you don't do this because you aren't as strong bias on the short side, but you can add at a level. You can take away at a level. You can add at a level. You can take away at a level. You can add at a level. You get the point here. You minus at a level. So this should have been enough right here to make your $100. That's the point I'm trying to make. Our rules work if you stay within that conservative time frame. If you get over $100, tighten the belt a little bit. Now, if you want to be super aggressive, well, I need $200. That to me is just being greedy. Okay. Again, a couple $100 in an account per day is a great paycheck when you start copying those over many accounts. That's all you got to do. So, but if you're still stuck in it, maybe you started trading later and you're like, oh, this is a good short bias. You add here, right? Add, minus, add, minus. You added. You added right here. Oh no, price is going up. You added right here. Unfortunately, you've got to look at this moving up through the level. Now here's another rule that you got to get. These are rules. You got to keep these rules in mind. Now again, I'm gonna train you through these rules. If you want some one-on-one time with me, I will train you through these rules. But you've got to recognize that price didn't stall at your level here. It went what I call a linear move. It pushed straight up, consolidated, and could not come back to the level. You've got to get out of that. That's going to be a loss. It's all there is to it. You're going to take a loss. You got 3 deep. I wouldn't be getting 3 deep in this. No. Now, what did I also see here? You look back. You had a lower low. Now you had a higher high, higher low, higher high, same low, but then another higher high. You've got to keep that in mind. Higher highs, higher lows. If you start seeing that, you start thinking, maybe I don't want to. Market's tanking now. You don't want to be in this trade still. So that's when you reverse. And then we're going to do the strong long here. Strong long bias. Again, same as before. This huge separation between VWAP and the 89 in this scenario. Same as before. When you get comfortable into this long, you can take these halfway points as adds. Okay? When it pulls back, halfway points as adds. When it pulls back, halfway points as adds. And you're doing the same thing. You're coming down here. Maybe you wait for a test to come back and say, okay, now I can add one here. You're one contract long now. You do nothing. You come back. You got an add. Okay, now you got a minus. You took one off. Pushes up. Comes back down. Now you have an add at this level because it's staying above your level. Okay, that's a big deal. Level to level. When price starts staying above your level, you start adding at that level. And then you can take one off. Then you get a little more aggressive now, and you can add at the level. You take one off. Come back. I will typically look at this. This is a great scenario to talk about. This is a perfect scenario to talk about a breakout add. So one of the rules that I haven't gone through here is a breakout add, and I'll show you one on the short side as well. But you get the scenario where you're testing the prior highs on the level, and then you get a nice little structure built here where price just stays here. In this scenario, when you have a strong bias, it's got to be a strong bias, not a weak bias. This is a weak bias. Okay, it's like my left arm right now. It's weak. Okay, this is like my right arm, strong. When you have a strong bias, you can add on a breakout, and then you're still going to follow the rules and minus. Oh shoot, that's supposed to be a minus. Minus at the level. Okay, same thing here. You can add on the breakout in a strong bias. You're still minusing on the level. Now when it comes back and test, you can add here, minus here, come back, you're testing a level, you're adding here, minusing here, you can add up here, and that's how you create huge days. So when you really look at this thought process, on the losing periods, you're losing maybe $100, $140 on the losers. But when you get the winners, but you're going to consistently bang out $100, $150, and then all of a sudden you're going to get a day like this where you bang out $200, $300, $400 in these micros. All right, let me show you a breakdown on the short side, and that will be it. So same thing. This is the same scenario here. I actually lost money. This is one of the days I lost money on. I'm okay saying it. Now, the only reason I lost money on this day is because I couldn't trade it from the short side. I had to leave. I had to walk away with my loss. Had I been able to sit in front of the computer, I would have flipped that around, took the strong short bias, and did exactly what I told you guys: add, take away, add, take away, add, take away, add, take away, and that loss would have been recovered in no time flat. But this is a scenario where you started out looking like a pretty darn strong bias. Why? Well, our rules say this is a pretty strong level here. Okay, let me back it up. Pretty strong level here, price stays above it. Pretty strong level here, price stays above it. I can stay on the long side. Our rules say 89 is pointing up. We're staying above VWAP. You don't know what's going to happen after that. All you know is that that looks like a good trade. And we started this off back here, and we actually made some decent money on the long side. Okay, add and take away. Now there is a level here that I haven't put in, so let me go ahead and put that in real quick too. That's around. I'm just gonna put one in real quick, and I'll come adjust it later. So I would probably, let me look at this. That's a good guess right there, but I'll come back and adjust that later. So again, what do? Same rule as before. Even if I'm stuck in a position up here, okay, and I'll tell you, this is a real thing. This happened. I got stuck in three. I was 3 long, okay, stuck in 3. Price comes down, shoots through the level, okay. That's typically in my mind when it shoots through the level, cut the trade as fast as possible, get out of it, or reverse it as fast as possible. I didn't do it that day. I was slow. Whatever was going on, it didn't happen. It's going to happen to you. Now, what you will always get a chance of in situations like this, most of the time, is when it gets to the next level. Now you got to cut that thing. You got to get out of here or reverse it and start trading to the short side. I don't want to stay 3 deep. I got to cut it. In a situation like that, you've got to lose that trade. Take the loss, $150, get out of it, take the loss, move on to the next trade, switch accounts up, and start trading from the short side. Okay? That's what you have to do. And again, I said that same thing from the long side. Close the trade or reverse it. I'm not going to reverse a 3 deep trade, 3 deep contract. If I'm 1 or 2 deep, I'll reverse it. 3 deep, close that thing as fast as possible. Save yourself some losses. Get out. Wait for the market to see. Wait for yourself to see that this is a strong downtrend now, and start trading that from the short side. All right, there we go. Those are the rules for my dynamic sizing methodology. Oh, shoot, let me say that. Let me say that on the video. Okay, those are the rules for our dynamic sizing methodology. If you follow those rules and you follow the bias video and you follow the levels video, you should be able to turn this process into consistent long-term profits that you can live on and make a paycheck on. All right, kiddos. What do you think, Paul?
I think that was excellent.
Guys?
All right. Well,
Let me let this one render.
yeah, definitely a good session. I agree, Dan. You put all that together
Thanks, Dan.
with the levels, you're good.
This is it. I mean, that's it. I did this to. I'm doing it this way because this is the way I'm trading. This is what I'm doing, and it's printing freaking money for me. I mean, you can't argue with results. You just can't argue with the results. Again, guys, here I'm gonna do this one quick thing. Results. I post these almost every single day. Oh shoot. Come on. Results. Guys, this is okay. Multiply that times 2. And then I still have another 2 accounts that I traded the M&Q on today. Anybody in this room going to be upset with that if they do that, one day a week, and then all the other days you're popping out $100 per an account times 8 accounts? Anybody?
Consistent, easy way to make a living.
This is just
With
simple
no real
and easy,
risk.
guys. Simple and easy. And I mean, that's literally what I gave is every single thing that I do. I gotta find some new levels now. But that's it, guys. That was, what time is it? I did that in an hour, Paul? Are you freaking kidding me?
Yeah, just in time too.
Jesus.
Gotta run.
I can't believe that. That's a short one for me. Okay. All right, I gotta roll, people. No questions, nothing like that. We'll have videos. I want these videos render, and then I'll have them to Tom later today, and then whatever he's gonna do with them, package them somehow. Oh crap! Oh, that's in the drive. Yeah, let me double check, make sure I still have my. Let's see here. I'm just making sure. Oh yeah.